please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. It's a good day for the market, second good day in running. So let's see how this plays out for the rest of the day. I did catch up with Sanjay Shah of Morgan Stanley from the sidelines of the Morgan Stanley Investor Summit, the 20th Investor Summit, and began by asking him about how he views the RBI's decision to hike rates this time around.
The Reserve Bank of India hiking rates, obviously it's against the background of corporate performance improving and the economy definitely showing some signs of a pickup. We also have the headwinds with stronger oil, with higher oil and a stronger dollar and with the Fed rates going up. So in some ways it comes quite naturally, though I think the market was evenly split between a hike or a no hike. It doesn't come as an entirely new or rather as a surprise. So that's one, and I don't think that by itself will have an impact on the equity markets per se. Separately on the equity markets, I think it's fair to say that after the strong run that we have had in the last few years, and obviously accelerated by the fact that the domestic flows had been strong, so also the overseas flows till at least the beginning of this year. With that as a background, I think we are going through a phase in the market where we need to consolidate and just wait out some time. So the longer term story for India remains really strong, but the near and now appears one should be a little bit cautious about it. Well, that's what I think.
Absolutely, because we've seen the flows taper off quite a bit since the start of the year, right? Yes. I mean, there's been outflows, especially in the debt market. Do you get a sense that foreign investor interest has waned, and is it just for the near term, or do you think the longer term story is intact as far as FPI flows are concerned?
So look, if you think about it and take the right perspective, over the last 4 years, we've seen almost $75 billion of overseas money coming into India between equity and debt. Year to date, we've seen slightly over $4.5 billion of outflow. Year to date in emerging markets, equities have seen about $52 billion of inflows, but India has really not got much. So fair to say, and in some ways justifiably so, that the relative attraction of India as compared to other emerging markets in the short term has waned a little bit. Again, it doesn't take anything away from the long-term story, because there's been fabulous work done by the government and the economic growth is just picking up. But yes, there is some short-term, rather a period in which India has to go through some kind of a consolidation, and that's why we're not seeing more inflows come through.
But do you see more debt outflows purely because of, the rupee depreciation, higher interest rates, higher crude, etc.?
Yes, there could be some more debt outflows, but our view now is that in the near term, the dollar has peaked out. And if that be the case, with oil prices also stabilizing, we could see some cushion out there. So I think we may not see more inflows, and it's not just for India, for the debt markets, it's for almost all the emerging markets, but it won't be a complete exodus, because most of the debt investors in India have put in money only over the last 2 to 3 years, and the longer term framework that they have is that over a period of time, given the fact that the macroeconomic balance sheet has been repaired by the government of India and very solidly at that, inflation over a period of time and real rates over a period of time will, or rather nominal rates over a period of time will continue to come down. So I think again there is a pause, some retracement, but definitely not an exodus.
Finally then, since it's very topical, the RBI's hike rates after so long, if this is the start of a rate tightening cycle by the RBI, if we see many more this year, we don't see any major negative impact on equities?
Look, I think that's in some ways symbiotically tied in with what happens to the global economy and what does the Fed do, particularly because that's really where everybody's really focusing on. Fair to say that over a period of time, and you're right, this is the beginning of the rate hike cycle, though the RBI has also said that they've got a neutral stance. I think the question is whether the economic growth continues at a pace at which it is able to absorb the rate hikes, and if that be the case, then the rate hikes by themselves will not impact the markets negatively. There are other factors for us to be worried about, but I don't think at this point the Reserve Bank's move to hike rates is something that will worry the market participants too much.
Okay, so that's the sum and substance of the Morgan Stanley view. Still quite confident that earnings will pick up. We've got another stock on our radar. The Kaya stock has lost nearly a quarter in value over the last 1 year, now trading at 52-week lows. Could FY19 fare better? Rajiv Nair, the CEO of Kaya, joins us with his outlook. Good morning, Mr. Nair. Thank you very much for joining us. First, if you can give us some breakup, what is the number of stores, which areas in India, and how many abroad?
Yeah, so actually, and thank you for inviting me into this show. If you look at the geography of Kaya, actually we operate in the India market as well as the Middle East market. We are present in more than 20 cities in India. We have more than 100 stores in India and about 25 stores in the Middle East. So largely India's largest dermatology chain with probably the largest number of doctors working in a dermatology chain in India, as well as also the largest aggregator of technology in the dermatology space in the country. So that's the broad background of what the business is in India and the Middle East. Middle East actually caters to more of a domestic market with local consumers, and in India it's a cross section of customers across the country, and we are in all the geographies of India really.
Okay. Rajiv, hi, good morning. Yes, of course, yours is a well-known brand and used by a lot of people. But I wanted to understand more about your digital foray. How much in terms of digital advertising are you going to be doing over the next 1 to 2 years? How are you going to increase your social media presence? And, you know, what would the ad spends be overall?
So overall, in terms of rupee value, I think we spend about 18 crores a year on advertising, which is basically the whole of the marketing pie, out of which about 70% of the spend is towards digital marketing. We actually believe the fact that we have been in the market for the last 14 years, so there is no need for really going above the line through mass media, print and television. So actually our focus has been for the last maybe more than 1 year on digital. We've been using a lot of influencer marketing. We've been in all the social media platforms which are there. All our acquisition of customers today, the new customers actually comes through the digital route. So I think the entire focus has been a digital first marketing channel for the brand.
Okay, but what's niggling? I mean, according to y'all, the fall in revenues, is this unbranded competition, standalone clinics? Why is it not like breaking out as a big story?
Oh, actually, if you look at the numbers, there is something different to actually say over the last 1 year. If you look at it, I think the business was fairly stagnant over the last couple of years, which is 15, 16, 16, 17. But if you actually look at the 17, 18 story, we have seen growth over previous year. The numbers are just about 5% over the previous year in terms of revenue growth. But in terms of profitability, there has been a significant improvement, especially in the India business. We've actually seen a 61% improvement in terms of EBITDA lines. So if you actually look at it from a minus 10% EBITDA for the brand a couple of years ago, last year it was about -3.
Okay.
All the stores in the chain are actually today broken even, and we actually have about a 25% EBITDA margin at a clinic level, at a chain level. And if you look at the cost lines below that, which is actually the corporate cost line as well as the advertising lines, are slowly coming down. So as a percentage in terms of fixed cost, in terms of corporate overheads, from a 21% it's come down to about 19%. And the clinic overheads are also almost flat over last year. So we are actually looking at driving, so if you look at the two most important things as far as we are concerned is to drive consumption within the business, and actually there are some good lead indicators there as well. So if you look at the average number of consumption sessions that we do in the clinic, from almost about 51,000 sessions a month that we were doing a couple of years ago. Last year it was about 58,000 sessions. Today it's about 60,000 sessions, which means our clinic productivity is actually gone up from 42% to close to about 48%. Gross margins have gone up from 74% to close to about 78%. We believe it can go up to about 80%. The only thing that we need to drive is new customer count. So one of the biggest things that we are doing is to actually make the Kaya services more affordable to customers. So you can see as we speak in this current financial year, almost a 15 to 20% reduction in terms of price. And I believe that will not impact our profitability as well. So I think there's a lot of change that we are bringing into the brand. We are making the brand affordable to a lot of customers. I believe the brand from a fairly HNI focused business is now moving towards a more upper middle class and maybe a slightly premium customer, but not necessarily only an HNI focused business.
Okay.
So that's the change that we're actually bringing in.
Just one final question, because we're running out of time. I have seen many of your products on other platforms as well, like Flipkart, Big Basket, etc., especially your hair care products. I want to understand from you any further plans to distribute your products outside the Kaya clinic?
Correct. Correct. So two things are happening. One is the fact that from a pure skin focus, Kaya has moved into a hair focus. So we built an entire portfolio of hair services in the clinics. And just to add to that, we have also added an entire array of products for hair care. So now from about 45 SKUs in the business, we are now about 75 SKUs ranging between skin, hair and essentials. And we already have distribution channels set up in various territories, right up from the whole of South, West and North. So you will start seeing the products. We are already present in about 140 points of sale in terms of products outside of the Kaya ecosystem. So that's the plan as far as product is concerned. It's already growing at the rate of more than 22% per annum for the product business.
Okay. All right, we'll leave it at that, Rajiv. Thank you very much for joining us with your plans.
Thank you.
Okay, so that's the word from Kaya. Well, the market's still holding on, but you know, there's a little bit of taking of the breath, as it were. But from today morning onwards, we are going to start a new segment and, more importantly, a new endeavor to find, analyze and present stock ideas that have lost a lot of ground from their earlier peaks.
Okay, could these stocks now find favor once again? We kickstart the series hunting for value by putting the spotlight on a couple of these stocks. The first stock today is Dilip Buildcon. Now, we've all seen the way that stock has fallen, but Anisha is here with her findings. If you've been wondering why the stock has fallen and what is the value, Anisha, tell us.
Well, yes, Dilip Buildcon has been cynosure of investors' eyes, given it has been quite a bit of wealth generator. Remember, the stock listed at 240 levels back in August 2016, saw a high of 1250 within less than 2 years, but now is trading around at the 800 level rupee mark. Now, of course, the stock got added to the ASM list in the last couple of days, and that's the reason the stock was coming under a bit of pressure. But other than that, also, there are quite a few reasons why the stock is seeing a bit of pressure. First off, there was some speculation that the stock is having, or the company is having, some auditors issues. To add to that, the street was a bit skeptic whether the deal that they had done with Shrem Infra Ventures regarding sale of the BOT assets, whether Shrem will be able to meet the outstanding due to them or not. To add to the nervousness, the CFO of the company suddenly resigned, Mr. Vaibhav Rawat. He suddenly resigned, and the street is also a bit concerned whether the company has bitten more than they can chew in terms of the management bandwidth as well as the big order book that they have now. But to assuage the concerns, the management did come out with a lot of clarification. They said that they're looking at a revenue target of 10,000 crores in FY19. They say there is no compression on margins, as well as they believe that the working capital days have come down to 96 days versus 130 days earlier. Also, they say that going forward, they do not expect any auditors' issues to come forward. In fact, they had issued a statement from the auditors itself saying that there is no clash between the management or auditors. In terms of the Shrem deal, they mentioned that they have already received 600 crores from the company, and going forward, as they progress, they will be getting rest of the tranche of around 1,000 crores. But the question is the street buying what the management is saying? Now, if you go by the brokerage calls, they are certainly buying the stock, because out of the 19 brokerages I looked at, 14 of them had a buy call on the stock, 4 of them had a hold rating, and only 1 of them had a sell rating on the call. If you look at the consensus target price, well, it was near the level of 1200, 1250, telling you that there's still an upside of around 40 to 50% on the stock. In fact, brokerages like Nomura and HDFC Securities came in favor of the company post the numbers. They said that the move of 13% lower that we saw post the result is a bit exaggerated. They do not see any concern regarding management bandwidth. They also say that the company would not need to raise any further equity or debt to meet its burgeoning order book as well. In fact, Credit Suisse just a couple of, they upgraded the stock as well. So a lot of positive brokerage action on the stock, but it is all about the valuations in this market, because the mid-cap space has been seeing a bit of pressure because of the expensive valuations. But if you look at the Dilip Buildcon stock and the peer comparison, you'll see that the stock is actually available at attractive valuations given the correction. So the stock of Dilip Buildcon is available at around 15 times the FY19 earnings, while stocks like Sadbhav and PNC are available over 20 times. And if you compare it with the revenue growth and PAT growth that they have given you, the likes of PNC and Sadbhav have given a growth of anywhere between 10 to 20%, but Dilip Buildcon has given you a growth of 50% on the top line and 72% in the year gone by. But of course, you know, before the street really looks out for more triggers for the stock, the street would want to be a bit more sure-footed, perhaps because they already have seen a bit of a value erosion when it comes to the mid-cap space. Back to you.
Okay, Nisha, thank you very much for putting so many pieces into perspective. I just want to reiterate, these are not buy calls or anything. We are just trying to analyze a stock give a 360-degree perspective, stocks that had fallen a lot and stocks where brokerages have very strong views. These are brokerage views and these are not CNBC TV18 views. We're just putting stocks on the table which have fallen and helping you make your own decisions on which stock you want to buy.
Also, I think, Anisha put it very well, the valuation comparison. I mean, Dilip Bilkon is trading at the lowest valuations compared to its
peers. With the highest order book and the highest growth in revenue.
Yes, so I guess that makes the argument a bit more stronger. But let's get our technical guests on board. Ashwini, I wanted your thoughts on Dilip Bilkon because, when this whole auditor issue cropped up, the stock fell a lot. Of course, those rumors were baseless according to the company. But I guess these are times when you get a chance to sort of buy good companies, right? Would that be your view as well, buy into stocks like these?
See, unless the company is cleared, and company's view obviously will be that there's no problem. Because, if you have controversial stocks or if there is some, fraud, something brewing, then the stocks sometimes can fall further. As we saw with Manpasand, say tomorrow there is some other report, etc. You want to keep away from these such messy stocks. Order book, who wrote the order book? The company. So, once you get into these auditor type issues, it's tough to get out. Instead of that, I think good, clean companies are much better. If there weren't any auditor issues, if it was just a cyclical issue, then obviously it's fallen from 1240 to about 780, you would have bought. But since you have such a large choice, you would be much better off trying to do things without auditor troubles.
Okay. Yes, that's very nicely putting the counter as well on the stock and a natural worry which investors would have and should have. With that, Ashwini, let's shift focus to the markets and the trading point. There was what looked like a very, very brief dip, and now again there is ferocious buying across all indices, mid and small cap. First, what's the Nifty trade?
Well, the bears tried their luck, but I think they have failed. And now the second rally is often more ferocious because now you have shorts also who probably entered today morning and would try to cover. Again, my view is that the smaller stocks, wherever there are short positions, will probably run up. Today's Chupa Rustam is cement, which is moving up fairly strongly. India Cement, ACC, Dalmia Bharat, all of these stocks are running up fairly hard. Similarly, aviation is moving up, nothing much to do with policy, etc. But if you see housing finance, again, Canfin Home is up almost 2-3%. So important to play where there were short positions. Even Oro Pharma, now it's moving higher. So that way, for the moment, TVS Motor is a buy with a stop of 570, target of 584. Indigo is a buy with a stop of 1175, target of 1230. And India Cement is a buy with a stop of 114, target of 126.
Okay, Chupa Rustam, I like that. Well, for now, the mid-cap index is actually picking up quite a bit. And if you look at some of these names, Gru Finance, Future Consumer, Endurance, Godrej Properties, all looking so good, up about 2 to 7%. Mitesh Thakkar and Rajat Bose are also with us. Mitesh, from a trading angle, what would you be looking to buy now?
The Nifty has already hit 10,770 and kind of stabilized around those levels. Maybe we'll take some time to get past that. But with the gap up opening, I think, and a lot of stocks also opening with gap up, I think the bias remains on the positive side. So I suspect towards the end of the session today, we might end up higher from here. I have two buy calls right now. M&M is a buy with a stop at 912 for targets of 950, and Tata Motors is a buy with a stop at 292 for targets of 310.
Okay. Well, let's get to Rajat. Good morning to you, Rajat. What are you trading?
I actually have chosen 3 stocks. One of them is in the futures segment and 2 I am giving cash levels. To start with, Jindal Steel and Power, stop below 239. Targets would be 251 and 255. Its formation looks pretty good. Short-term W formation, which is a very bullish formation. So chances are that you will see good move happening there. The 2 targets might well be met tomorrow, may not be met today. but one should hold on to the long position unless one gets stopped out. And the second stock would be Just Dial, which I personally hold in my investment portfolio. That's a disclosure. I would say June futures you buy with a target of 560, 566. It could even go up to 569 and put a stop loss. When I gave, the stock was at a much lower level. So the stop I placed at 539. Now you can upgrade the stop to about 545. So these are the two stocks. Apart from that, Motherson 308.80 is my stop loss. 318 to about 320 would be the target for the day.
Okay, thank you very much for that. Ashwini, I again wanted to come back to you on the bank stocks. Is there any specific bank stock that you would play since the Nifty Bank has done very well?
Well, on banking, I think Yes Bank had a few down days. That's where you could look at. I think today Axis Bank, ICICI Bank and maybe Federal Bank are the places where you look at, because the stocks need to have some short positions. I don't think there is great flows which are coming. So if you see today, Bajaj Finance, FinServ are kind of soft. So even in banking, try to choose stocks where short positions may be there. So maybe go with Axis and ICICI.
Okay, well, we will keep coming back to you guys for more. For now, it is looking pretty good for the markets, especially for the broader markets. It's the metal names. JSPL is up 4.5% right now. And as I said earlier, JSW Steel has hit a new high, so looking good there. Manisha Gupta is with us. Since we're talking about metals, let's get a roundup of what's happening in the commodity and the currency markets globally. Hi, Manisha, what's the latest there?
Well, this is a market that has opened mostly in the green. We have seen the US dollar take a bit of a pause in that rally, and we also are looking at strong fundamentals supporting many of these commodities, starting with the crude oil prices. And while we did see a 2-month lows in the New York session yesterday, there is buying on all dips that we have come in for this space, and that's exactly how it's going to be until the 22nd June meeting is out of the way. While, of course, you are looking at record high production from US, exports hitting records as well, and the markets also have seen a build-up in the inventories. But then again, Aramco has increased the crude prices for Asian consumers to the highest in 4 years, looking at the strong demand, and that seems to be adding premium to those prices there. The gold and silver prices have been quite choppy as well, but we have seen some buying come back into this one as well. So on your screens, 0.25% to 0.5% gains coming in for both of them. There also are reports on how Europe now seems to be buying gold on the lower levels, and there is some buying that is trickling in from the Middle East as well. So good physical buying is something that clearly is positive for that space. The base metal sector, of course, continues to be the star performer. We have seen copper prices trade around at a 5-month high, a percentage point of gain yet again. The gains clearly have been much higher in Shanghai than what we have seen in LME, but clearly Indian markets taking cues from both of that. Aluminum prices have been gaining because of the shortage in supply reports that we have been seeing in. The best of gains, of course, have come in for the lead prices. That one is trading at an 18-month highs in Shanghai, and the reports that one of the provinces in China will now cut output by 30% is something that this commodity would be taking cues from. Nickel and zinc, of course, have been good performers as well. Strong steel demand, steel inventories declining, and especially with the kind of concerns that we are seeing in sense of nickel output from China also is something that has been supportive. There actually is no sell strategy that we have seen come in for the base metal prices for 3 weeks now, and today we have strategies from Kedia Commodities who continue onto the buy side of this space. For copper, they're looking at upside targets of 485.5 kg. They also have a buy strategy continuing for zinc prices. 216 on the higher side is what they are watching out.
All right. Thank you very much for that, Manisha. We will have to take a break on that note. We now move to other areas. We'll look at real estate. Irfan Razak, the Chairman and Managing Director of Prestige Estates, joins us now for credit policy takeaways and for the state of the sector itself.
Well, we're going to analyze some numbers now and talk to some companies about the way forward. Real estate is on our radar, and one of the best minds in the business, Irfan Razak, the Chairman and Managing Director of Prestige Estates, joins us now to tell us about the way forward for the market and his own business as well. Mr. Razak, good morning. FY18 is now behind us. You had a fairly good year with a revenue growth of 15%, profit growth of 14%. But just tell us a little bit about what you expect in FY19. You've laid out a guidance, new sales sales value of around 3,500 to 4,000 crores. Your turnover is not very different from what you did in FY18. You're expecting a turnover of 3,500 to 4,000 crores. Is this a conservative guidance, or do you expect that demand is a bit subdued in the industry?
No, the guidance that we've given is for the sales that we will do in the year FY19, because the turnover is very different from guidance, I mean from the sales. The basically top line revenue is more related to the amount of revenue that we can book based on the percentage completion method. And the sales are the actual sales that happen on ground, quarter on quarter, year on year. Last year has been good. FY18 has been good. We've clocked about 3,300 plus crores of sales. And we look forward to a similar run rate, if not more. That's why we've guided 3,500 to 4,000 sales in the current year. It's about 15% higher than the what we've achieved at the moment in the previous year.
Okay. Mr. Razak, good morning. Can you just,
Morning,
to the best extent you can, give us an idea of how the next 3 quarters, you've already seen 2 months of this year. How is it looking? Is it looking better in terms of demand? Do you think you can be, push up realizations and margins? Or will there be resistance, so you will bank more on volumes than value? What are your thoughts at this stage?
Now, see, we have to do a blend of both volumes, value and all of it. But as you rightly said, we are already 2 months into the quarter, and the quarter is looking good. And the other good news is, since the uncertainty of GST, RERA is behind us, we have got a slew of new projects which are almost approved or under approval, which will be coming into the market, and which we can launch without any difficulty once it's registered with RERA. So even these are, so there's a nice steady launch pipeline that we have quarter on quarter with products across different parts of Bangalore city, and we've also got something happening in Chennai. So I believe that there is a lot of scope, and the current year also will be equally good, if not better than the previous years. And but rightly pointed out, as far as margins are concerned, it's a balance of both the things. It's the efficiency of how we are able to bring our construction costs in line and also get a better realization, because customer is definitely not willing to pay for either my extravagance or my inefficiency. And I think the teams have been sensitized on this, and I believe that going forward we'll be clocking much healthier margins as we go along.
Okay. I also wanted to understand what the impact of the ordinance to amend the IBC, what would that have, the impact be on the real estate space? I mean, home buyers will now get a bit larger say as far as insolvency cases are concerned. What would your own thoughts be?
Yeah, I mean, now it all depends. If some company gets into trouble, they are in trouble. And always, I mean, the law has been made now, but I always believe if you've received advances from your customers, you are responsible for those advances till you deliver the product that you have promised to deliver. Of course, it's also the accounting methodology and all of it. And there is also a likelihood that this quarter the accounting methodology itself may change, which will be very drastic, which is that Ind AS 115, and we're still not clear. I think we'll come to know about it very soon, which method to adopt, because currently all real estate companies are adopting the percentage completion method. And there is a likelihood that we'll be pushed into adopting the completed method, which I personally believe is a good one, but then it'll be, the numbers will be very lumpy. You'll have 2-3 quarters of losses and then a quarter of huge profit, which really will not give you so much of so nobody can analyze exactly what's happening. But then that's what's real estate. But this percentage completion method was something that gave you a steady revenue throughout every quarter. But we'll wait and watch. The representations have been made by the industry, It all depends on what the Finance Ministry and the Commerce Ministry finally decide.
But generally, the new IBC norm, the amendment in favor of homeowners, will it be a niggling worry? Or, I mean, I don't even know if all homeowners can unite and present a forum. How are you as a person in the industry looking at this development?
No, I think it's a good move. I won't say it's a negative move.
No,
it just gives that much more confidence to the buyer that they will not be left high and dry and stranded in case something goes wrong. And actually that will work more positively in favor of home buyers rather than and the companies who are building homes, that it gives the confidence to them, listen, that you're fully secured. It's like if you're depositing money in a bank, you're not sure whether you're going to get that money the next day. That's not a good feeling. Similarly, if somebody is depositing money with a developer, they also need an assurance that their money is safe.
No, I just wanted one last, clarity from your end. You mentioned this Ind AS 115. Everyone's talking about it. It seems imminent right now. So, just for our viewers, this actually replaces the existing revenue recognition method, right? If this is done, how much of an impact, how much of a negative impact do you think this would have on the industry?
No, it won't have a negative impact in any sense. But what happens, the reporting changes. And you will not get the clarity on exactly, I mean, in fact, I prefer this, the completed method, because then you're showing your profits at the end of the day, what actually you have earned. But now you are doing it based on the estimated cost and estimated income. Now it's on all real. But then the only, again, the overall problem is that the income tax department will want you to still follow the POS method so that the tax payment doesn't get delayed or doesn't get deferred. But the accounting standards are telling you one thing, so you need to draw up 2 balance sheets and 2 P&L accounts, which will be very difficult for the companies itself.
Confusion ahead. All right. We'll leave it at that. Thank you very much, Irfan Razak, for joining us with all those details. We'll take a break. We are coming back with another biggie from the corporate world. Anil Kumar Jha, Chairman Managing Director, Code India.